Hey everyone, and welcome to today's Explainer. I'm your financial coach, and today we are going on a serious money mission, decoding your very first paycheck. We're going to break down exactly how cash moves from your employer's bank account straight into yours, and honestly, what happens to it along the way. So let's just dive right in.
I am so ready for this. I actually just landed my very first full-time job, and, I've been doing all the math in my head.
So my boss just told me my starting salary is $3,000 a month. I am officially rich. I'm already planning out my brand new apartment. I'm definitely upgrading my phone, maybe booking a weekend trip. I mean, $3,000. That's literally going to cover absolutely everything I want to do.
The sheer joy of the offer letter. It really is an amazing feeling. But hey, before you go adding all those luxury items to your virtual shopping cart, let's fast forward a couple of weeks to when that actual first direct deposit hits your bank account.
Hold up. What is this? $2,400? Where on earth did the other $600 go? Did my company mess up payroll or something? I thought my salary was $3,000.
No mistake, I promise. This is honestly one of the biggest shocks for anyone entering the workforce. Your salary just isn't necessarily the exact amount of money that reaches your bank account.
So why didn't I get my full $3,000? Like, where exactly does it go? To answer that, we just need to follow the money. We're going to trace the journey of your paycheck using 4 specific steps: gross, deductions, net, and budget. Understanding this pipeline is absolutely crucial for financial survival. Let's start right at the beginning. That initial $3,000 you were so hyped about, that's your gross income. Gross income is simply the amount of income earned before certain taxes and other deductions are taken out. Depending on your gig, this might include your base salary, hourly wages, commissions, or even end-of-year bonuses. But the big takeaway here is that gross income is just the starting point of your paycheck. It is definitely not the finish line. Okay, so gross income is basically the total amount I earned on paper before anything gets touched or removed. You hit the nail on the head. Gross income equals your income before applicable deductions. You earned the $3,000, but you just don't get to take all of it home. Various deductions are withheld from your earnings, and that depends on the country you live in, your specific employment situation, and whatever the applicable laws are in your region. Deductions like taxes? Precisely. Taxes are amounts collected by governments, and yeah, I know nobody loves seeing their paycheck shrink, but these funds serve a really vital purpose. They help fund the public services that we literally all rely on every single day. We're talking about public education, emergency services, maintaining infrastructure like roads and bridges, and public safety. Different countries and even different regions have totally different tax systems, so the exact amount they take out will always vary depending on where you happen to live and work. And that brings us to one of today's most important concepts, your net income. This is the amount left over after applicable taxes and other deductions have been subtracted from your gross income.
Okay, so going back to my mini panic attack earlier, that $2,400 deposit is my net income. That's the actual money I have available to spend?
You got it. In our simplified example, $2,400 is your net income. That's the real spendable money that successfully navigated the pipeline and landed safely in your bank account. Because this is such a critical concept, I really want to highlight a massive trap that so many people fall into. Never, ever budget using your gross income. You must always budget using your net income.
Right, because if I plan my life around $3,000, I'm going to be short by $600 when it comes time to actually pay my rent.
Exactly. That is the golden rule of personal finance, right there. Don't build a lifestyle based on money you don't actually have in your bank account. You have to start with the realistic amount you expect to get after deductions. All right, let's pause for a quick interactive challenge for everyone following along with this explainer. Let's say a worker earns $4,000 in gross income. After applicable taxes and deductions, $800 is taken out. What is their net income? I'll give you a second to do the math.
Oh, I know this one for sure. It's $3,200.
Spot on. 4,000 minus 800 leaves a net income of $3,200. If you got that right at home, you are officially mastering the difference between gross and net. Okay, so I totally understand my net income is $2,400. But honestly, I'm kind of concerned. Even with $2,400, I feel like my money just vanishes into thin air. Like a $5 coffee here, $15 for a streaming service, $25 for food delivery, $80 online shopping. And suddenly I look at my banking app and half my net income is just gone. Where did it all go? That is the million-dollar question. Without a real plan, money is going to disappear surprisingly fast. Those small daily expenses, they add up quick, but there is a tool to stop the disappearing act before it becomes a serious problem. And that tool is a budget. A budget is simply a plan for how you will use your income to meet expenses and financial goals. Notice I didn't say a budget is a punishment. It's just a tracking system. A good budget actually empowers you to make intentional decisions with your net income, rather than just spending first and wondering what happened at the end of the month. So the very first step of budgeting is separating your needs from your wants. Needs are your survival essentials. We're talking housing, basic groceries, necessary transportation, and your essential utilities. Wants, on the other hand, are the lifestyle choices, entertainment, luxury travel, and eating out at fancy restaurants. So wait, does this mean I can't buy that new phone I wanted? Are wants just automatically a bad thing?
Not at all, and this illustrates a huge misconception about finance. Wants aren't bad. Unplanned spending can be. It is perfectly fine to want a new phone or to go to a concert or to eat out. The question is simply whether those wants fit into your financial plan right alongside your needs. If you plan for it, you can enjoy it totally guilt-free.
To help you actually plan for those needs and wants, you really have to understand how your expenses behave. They generally fall into two categories: fixed and variable. Fixed expenses are super predictable month to month. Think of your rent or your insurance payments. The bill is pretty much the exact same every time. Variable expenses fluctuate based on your choices and your habits. This is your food, your entertainment, or your shopping. Knowing which expenses you can actually control, the variable ones, gives you the power to adjust your budget whenever you need to. And here is where budgeting gets really exciting. A budget isn't just about limiting your spending today. It's about directing your money towards your priorities for tomorrow. We're talking about financial goals like funding your education, saving up for a car, or even planning for a future home.
Wow, so budgeting is actually how I make those big dreams happen? It's not just about paying the boring bills?
Exactly. Budgeting creates the actual roadmap to hit those gold star goals. Let's look at a real-world case study to see this in action. Let's meet Maya. Maya has a monthly gross income of $3,500. After $700 in applicable taxes and deductions, her net income is $2,800. For her budget, she allocates $1,000 for housing, $400 for food, $250 for transport, and impressively $500 straight into savings. She assigns every single dollar of her $2,800 net income to a specific job before she even spends a dime. Okay, that is so smart. She knows exactly where everything is going before the month even starts. There are literally no surprises. That is the goal. And you can do exactly what Maya does by just following this simple 3-step money method. Step 1, know your real income. Identify that gross amount, understand your deductions, and find your true net income. Step 2, plan your money. Divide that net income across your needs, wants, and financial goals. And step 3, check and adjust. At the end of the month, sit down and compare your plan to what actually happened. Did you overspend? Did you save what you intended? Just adjust it for the next month. Now, for all our students out there taking the AP Business and Personal Finance exam, we've got a rapid-fire exam alert for you. You absolutely must know the difference between these core terms. Gross income is your income before applicable deductions. Net income is what remains after taxes and deductions are taken out. And a budget is your master plan for managing income, expenses, savings, and goals. Lock these definitions in your memory. And that brings us to our final, most important thought for this explainer. Don't just earn money. Learn to manage it. Now it's your turn to think about it. When you get that very first paycheck, what are you going to do? Are you going to just spend it all immediately on a shopping spree? Are you going to lock it all away in savings? Or are you going to sit down, find your net income, and create a solid plan first? We highly recommend the plan. And more importantly, once you master budgeting, how are you going to make that savings pile actually grow? Well, we'll tackle investing next time. If this explainer helped you decode your paycheck and understand taxes, net income, and budgeting, please hit the like button, subscribe, and share this with someone who just got their first job. Thanks for learning with us, and we'll see you next time.